Hey everyone, welcome back to Actual Investing. Today is the newest installment of my series called 5 on the 5th, where I talk about 5 compelling stocks on the 5th of every month. So it's actually the 10th of the month. I'm a bit behind this month, but I still wanted to make the episode because some of you have been asking about it, so it's really cool to see that you guys do watch it and you do, I guess, look forward to it. So today, let's just dive right into it. The first stock I want to talk about is DigitalOcean, ticker DOCN. So DigitalOcean is a small cap stock. It's definitely a risky stock, but potentially a high reward type of stock. So DigitalOcean, what do? Because they are pretty complex. They are a cloud computing company, and essentially they offer what's known as a virtual machine or a virtual private server, a VPS, to small and medium-sized businesses. So essentially small businesses can use DigitalOcean's servers to host their website or their e-commerce platform or run their cloud applications without actually having to have their own servers in-house. So DigitalOcean calls this infrastructure as a service, or IaaS. And before IaaS, or IaaS, I guess I'll say, businesses would purchase their own hardware and software, which was costly, and not everybody always had the resources to do that. So that's where DigitalOcean comes in. So DigitalOcean offers something called droplets, which create a remote IP address for your website, which is hosted on their data centers. So this remote IP is essentially associated with some computer somewhere in the world that is owned by DigitalOcean that brings up your content. So with these droplets, DigitalOcean's infrastructure as a service offering, small businesses can just pay for what they need, and it provides them with the servers that they need to run their applications, which is all maintained and owned by DigitalOcean. So you can reprogram these as you like, but DigitalOcean actually maintains the physical computer. They have 13 data centers globally, and what I think is most compelling is that they are much lower cost than some of the other hyperscalers. So think like an Amazon Web Services or a Google Cloud. DigitalOcean actually says that they're 50% cheaper than AWS and Google Cloud. So you can definitely see the appeal of this business to small and medium-sized businesses who don't have a lot of money to work with. However, some may argue that DigitalOcean doesn't really have much of a moat because they're competing against these giant hyperscalers, Amazon, Google, Microsoft. These types of companies are huge threats to DigitalOcean. However, I think what is really compelling about DigitalOcean is they've sort of found their niche in small and medium businesses who have historically been underserved by the hyperscalers. If you want a cheap option, Amazon Web Services isn't going to give you the same thing that DigitalOcean is going to give you. DigitalOcean will let you pay for just what you need, and you'll end up paying a lot less than you would at Amazon. So let's talk about DigitalOcean's recent earnings report. So this is their release. One thing that I like to check first and foremost with any growth stock is, did they meet their revenue expectations? So this is last quarter's earnings, and they said for this quarter they expected revenue between 182 and 183 million, and look at that, they hit 185 million. So they beat expectations, that's good. However, their revenue growth is quite slow at 12% year over year. So this is definitely not a hyper-growth stock. However, what you do get with DigitalOcean is profitability. So DigitalOcean does make a profit, at least they have in the past few quarters. So DigitalOcean is the type of stock that I look for where they have growth alongside profitability. I would ideally like to see more growth or more profitability, but I don't want to be too picky. This is a small cap stock. It does have a relatively fair valuation of about 4 to 5 times annualized sales. So you're not paying a lot for the growth that you're getting. We also can see that growth is accelerating slightly. They had 11% year-over-year growth last quarter. They have 12% year-over-year growth now. So it's hardly worth mentioning, but it is good to see that growth isn't quite done yet. All right, so before I eat up too much of your time, let's talk about the next stock on my list, which is Duolingo. So Duolingo is probably a stock that most of you are familiar with, especially if you live in the US, because that is where Duolingo derives most of its business. But they do have about 40% of their revenues coming from their international segment as well. So maybe if you're not in the US, you'll also have heard of Duolingo. So Duolingo is a language learning app. It's language learning software. And at first when Duolingo IPO'd, I was extremely bearish because I did not see how they would have any kind of moat or how they would distinguish themselves or monetize their offering. To me, Duolingo was a free app, and I didn't think they were really going to make much ad revenue from this little language learning app. But one of the biggest things in investing is that you need to be able to change your views and change your mind. So I went from being very bearish to Duolingo to actually being quite bullish. So my only concern with Duolingo is their valuation, which we will also get to when we look at my spreadsheet. I'm going to do that at the end of the video, so please stick around or just skip ahead. I mean, I don't really mind. So anyway, Duolingo also just reported earnings very recently, and they did beat expectations, and they do have a very strong revenue growth. So let's take a look at what is going on here. So we can see that the biggest growth driver for Duolingo is their subscription. So this is people who use Duolingo's app to learn a new language and pay to get the premium option, so they don't have to see ads and they can get more features. So we can see that this grew 53% year over year. So in the first quarter of 2023, they had about 86 million in subscription revenue. Now they have about 132 million in subscription revenue. So that's awesome. That's still a good growth driver for Duolingo, and they have a diversified revenue stream. So even though subscription is their primary source of revenue, they also make money from advertising, in-app purchases, and this Duolingo English test. So, Duolingo English test, I hadn't heard of that until I started analyzing the stock recently. It's actually very interesting. So, the Duolingo English test is something that people who are not native English speakers can take to certify that they're proficient so that they can get into schools in the US. So, let's say you are originally from Spain and you speak Spanish, but you want to go to school at, say, Yale. You can take this Duolingo English proficiency test to prove that, yes, you can speak English at a proficient level, which helps your acceptance into, say, Yale. That's just an example. But it's a very, very interesting offering. It's also worth noting that Duolingo also partners with educational institutions, and so some of the subscription revenue is not just everyday average Joes on their phones. Some of this is actual higher learning facilities. All right, so let's just go to my spreadsheet, and then we'll talk about Duolingo, DigitalOcean, and the other 3 stocks of the day. So this is an abbreviated version of my spreadsheet tailored to today's video. Here are the 5 stocks for the day. We have the 2 we talked about, DigitalOcean and Duolingo, and the 3 I'll talk about next, Shopify, First Solar, and Broadcom. So let's look first at DigitalOcean and Duolingo, because that's what we've been discussing. We see that these 2 actually have the lowest scores on my spreadsheet. DigitalOcean is being punished because they are a small cap company, and if you're unfamiliar with my spreadsheet, it tends to reward larger companies. So I rate on these 4 factors, which are gross margins, annualized revenues, price to annualized sales, which is a valuation metric, and revenue growth. So each of these metrics gives the company a score out of 5, and then I aggregate those scores for a total out of 20. My average is about 12. So on this list, the average is 12.6, but in my overall list, the average is about 12. So DigitalOcean gets a score of 10, which is honestly not great, but let's talk about why I think they're still maybe worth considering. So one thing that my spreadsheet punishes is a low annualized revenue. However, DigitalOcean is a small company, so even though they only have $740 million in annualized revenue, that is actually kind of significant for their $3 billion market cap. So we see their price to annualized sales is only about 4.3, even after today's slight jump. And like I said, they do have revenue growth now of, I'll change that to 12% year over year. So even though it doesn't score very well on my spreadsheet, I think it's worth noting that sometimes small caps you have to take a little bit of a risk on. And I'm not saying that I'm advocating for taking on risk, but I am saying that that may be part of the reason why DigitalOcean doesn't score well on my spreadsheet. I do think if you're bullish on cloud computing, which is a huge growth driver for companies like Google and Amazon, I think it may be worth looking into the only other company that seems to be catering to small and medium businesses. I think that as the economy recovers, small and medium businesses should lead the charge. They're the type of companies that aren't doing so well right now because they have a harder time accessing capital and they're a bit more sensitive to the economy. So as rates start to fall, I believe small and medium businesses will begin to thrive again, which should lead to a reacceleration in growth for DigitalOcean. So DigitalOcean, a very speculative play, a very high risk play, but still something that I'm quite bullish on. Duolingo scores slightly above my overall average with a 12.4. What's helping them is their strong revenue growth of, again, like I said, 45% year over year, which is great. Their valuation is not cheap, but also not terribly expensive at about 12 to 13 times price to annualized sales, and they are very close to hitting that 1 billion mark in annualized revenue. The other thing that's nice about Duolingo is they are a platform, and platform stocks tend to have high gross margins. So we see that here, they do have high gross margins. The reason for that, by the way, is that when you have any kind of subscription service, adding more users typically does not add a proportionate amount of costs. So these types of businesses do even better as they scale. So we're going to see this gross margin improve as Duolingo scales up because they are a subscription platform. All right, let's talk about Shopify now. We'll do the last three in kind of rapid fire. So Shopify also reported recently and was down about 20% on the day. Shopify is not a cheap stock by any means, but they are getting cheaper. So Shopify is quite massive with a market cap of about 80 billion and about 7 billion, just over 7 billion in annualized sales. They have a price to annualized sales of about 11. Like I said, not cheap, but not terribly expensive with strong double-digit 26% year-over-year revenue growth. Shopify is a play on e-commerce, so if you're bullish on e-commerce or, again, small and medium businesses, Shopify may be something to look at. Shopify essentially offers solutions to sell products online and in stores. They do have a physical in-person, in-store solution as well for small and medium businesses. So they are compared to Amazon, but they operate in a slightly different niche than Amazon. If you have ever supported a creator on YouTube by purchasing their merchandise, a lot of that also comes from Shopify because they recently integrated with YouTube so that you can sell products on your YouTube channel. So Shopify, I did actually purchase shares of the other day. If you're a regular viewer, you know that I've been buying a lot of new stocks lately. So maybe it's time for a portfolio update here soon. But I have been trying to diversify. And just a quick comment. There's been some people who have said that I own too many stocks, which, yeah, that's true. So if you are looking for a high risk, high reward type of stock picking journey, then what I do is totally different than that. I'm trying to build a diversified basket of quality companies. So I don't mind if I own, 30 to 35 stocks. For some people, that's a lot and that's too much to keep track of. However, this is my hobby and this is also my job. I do work in finance. So analyzing stocks is a part of my day-to-day. So I'm perfectly happy to keep up with about 30 to 35 stocks in my portfolio. I don't have anything against that. So to me, it's just added diversification. Anyway, let's also talk about First Solar. So First Solar has been my favorite solar stock lately. So if you know me, you know I'm a bit of a tree hugger, so I am bullish on clean energy, but clean energy has just been not doing well lately. If you are an investor in any kind of solar stocks, you know exactly what I mean. Stocks like Enphase and SolarEdge have just been decimated. Shoals, my small cap solar play, has been doing terribly as well. And most of that is due to interest rates. So when interest rates rise, solar becomes less appealing because most solar projects are financed, especially residential solar. Residential rooftop is typically financed. So when rates are high, it just doesn't make sense for a lot of consumers to purchase and install solar panels. So First Solar does manufacture solar panels. And this is another stock that I was initially bearish on because I figured there would be a lot of competition from China where solar panels are manufactured very cheaply. However, and I don't want to get into politics, but there have been tariffs now that the U.S. has placed on Chinese solar panels, which has led to this massive growth for First Solar, which is a U.S.-based solar panel manufacturer. So First Solar actually just posted 45% year-over-year quarterly revenue growth, which is insane for a hardware company. Essentially, they make hardware, which is what a solar panel is. They have a decent valuation of about 7 times annualized sales. If you look at this last quarter, they have about $3 billion in annualized revenue, and their margins are steadily improving at 44% gross margins. The other thing that I like is that they really don't have a lot of operating costs with SG&A and R&D, both being 15% or less. So First Solar is a highly profitable, quickly growing solar panel manufacturer that will benefit from the increased demand of US-based solar panels. So if you're bullish at all on solar, First Solar may be worth a look. All right, and finally, let's just quickly talk about Broadcom. I've already talked for so long, but Broadcom is a semiconductor company that specializes in chips for networking solutions. So think data centers where a bunch of computers need to communicate with each other or network. So Broadcom is a massive company. They're almost a $1 trillion company. I mean, they're not. They're a $600 billion company, but who knows? They could become a $1 trillion company within the near future. They have impressive gross margins, and their valuation is relatively reasonable for the amount of growth that they're posting. Personally, I do not own Broadcom. It's something that I would love to own at the right price. I own Arista Networks instead, which is in a similar niche and caters to networking. One thing that I love about Broadcom is that they don't just sell chips, they also sell software. So they have a software and hardware-based business, which balances each other out very, very well. It's well diversified. Both have very strong moats. They actually sell chips for iPhones and data centers. So no matter what type of technology is growing in a particular year, Broadcom should stand to benefit. So when iPhone sales slowed down, they made up for that with their data center growth. And so I imagine when data center growth slows down, they'll make up for that in another segment. So Broadcom is just a very, very impressive company, a very, very strong blend of software and hardware, and I really like this business, and I'm hoping that I can get into it at a relatively decent valuation. I am still on the sidelines waiting for some kind of pullback. All right, so that's 5 on the 5th. The 5 stocks that I think are compelling this month are Broadcom, ticker AVGO, First Solar, ticker FSLR, Shopify, ticker SHOP, Duolingo, ticker DUOL, and DigitalOcean, ticker DOCN. Do you agree with my picks? Do you like my picks? Do you hate them? Please comment down below. Please let me know what you'd like to see. I have 3 recommendations lined up for stocks to review, so I'll get to those probably next week. I'm very excited. Thank you guys again for watching and for suggesting stocks for me to cover. If you did like this video, please go ahead and click that like button and please subscribe if you have not already. Helps me grow the channel, and I've been really enjoying putting out content for you guys, so it's just encouraging to see that you all like it as well. So anyway, thanks again for sticking around, and I hope you all have an awesome day.